Good afternoon. Welcome to the TheoTRADE Afternoon video. I'm Blake Young. Today is March 13th, 2025, and we're going to continue my conversation with you from Tuesday talking about inflation and how that could impact commodities, but we're going to focus more on the specifics to the sectors with that inflation and PPI's results today. And to begin with, we're going to look at this chart that we have on this screen right now, and that is the S&P 500 versus all the sector ETFs. As you can see, pretty much everything is falling. Everything is negative, negative, negative through the month of March, starting right through here. And in addition to that, from the rolling quarter going back 3 months, everything is below zero or falling or negative returns except for this top sector. Now, if we compare the top sectors to the bottom sectors, these bottom two sectors are going to be your consumer discretionary and technology. Your top two are going to be healthcare and utilities. And utilities are the only ones really trying to carve out an upward move for the day, trying to push up into this tiny positive result for the day. But overall, it's defensive sectors versus growth type stocks. And so we're going to look at where we can find opportunities in those growth stocks. If we are the type of traders that don't like to short or go bearish the market, we need to lean into those things that give us bullish opportunities, which would be these defensive sectors. Even if it stays flat, there's ways to create income and growth even on these sectors that are not necessarily making money over the last quarter. We can still make money in those positions. So let's go in and look at that here right after we look at PPI. PPI, or Producer Price Index, is the inflation reading for producers. Now, producers' inflation reading generally has a forward-looking view towards CPI, or Consumer Price Index, because if producer prices are rising, then they have a tendency to either lose on their earnings or pass it on to consumers. If consumer or producer prices are falling, they may or may not pass that on to consumers, as we've seen during the COVID lockdowns and the high spike in inflation. When prices started drifting lower, the producers and the resellers and the manufacturers all kind of left their prices high. And that includes food and energy, grocery, clothing and apparel, everything pretty much stayed high. Now, let's take a look at this PPI a little bit deeper. Core PPI is taking out food and energy, and you can see if we take out food and energy, which was already negative, then it says we're negative even more. So food and energy apparently was higher month over month if we see core food and energy, or core PPI, is negative and regular PPI is positive. If we look at this from a month-to-month view, this move to zero has happened before, and going negative is not uncommon for producers month over month. It's how this feeds into the consumers. You can see that highly negative, or what you'd call disinflationary, back in May of 2020, as producer prices tumbled down negative 1% from the previous time period, and then we spiked higher after the fact. So just the fact that we dropped down here does not mean it's going to get to the consumers. They could stay the same, and then if we have a higher inflation reading next month, then the producers can pass that on to the consumer. If the tariffs stay in place and at 25 and 50% on steel and other metals and other core commodities like we talked about on Tuesday, then that will appear as higher costs that go into the manufacturing of other goods, other value-added goods, and that will have a tendency to lift the producer price index and later consumer pricing as well. But right now, it's showing a slowdown, a cool down. And I think what people are going to look for is, does this end up in the consumer's pocketbook, or is it an indication of lack of demand? And if it does end up in the consumer's pocketbook, is that going to be delayed, or is it an indication that we're slowing the economy down and therefore the Fed's going to cut rates? I mean, there's lots of questions in this on how this will play out, even though it's gone to 0% month over month. And remember, that's a net 0% month over month. It doesn't mean that inflation disappeared. It doesn't mean that we went from 0.4% to 0%. It means that we didn't move compared to last month. So we increased by 0.4% and those prices stayed the same. It's the negative that shows you a decrease in costs. So that being the case, I don't see a case or a justification to assume that the consumer is now back to full strength and we're going to see growth and we're going to see spending and we're going to see expansion. Rather, I see that we're still in a defensive mode, which is part of the reason why we already see the quarter-over-quarter movement into healthcare and utilities and away from tech and consumer discretionary spending. Let's go back to that, with these top two being utilities and healthcare, and these bottom two being consumer discretionary and technology. Consumer discretionary is down 18% from a quarter ago, 1 quarter ago, 3 months ago. But it's from this level, you can see that we're down, that was the high 3 months ago. So we're down 18%. That is not just a pullback. That is pushing to the edge of, if not indicating, a bear market for consumer discretionary spending, the cyclical behavior, the stuff that we don't need but we want. That is what is getting knocked down. Healthcare has been able to maintain at a 2%, even with the market pulling it down, and from the high to the low, it's only down about 4%. So let's take a closer look at healthcare and utilities, and we're going to focus more on price rather than any specific indicator. What I'm looking for, and if you join me in the main room today, what I'm looking for is a higher low. What I'm looking for is a divergence. What I'm looking for is a bounce. So I'm looking for any type of indication that if this is the stronger sector, and we'll do healthcare next, if this is a stronger sector, I want to be looking to be bullish inside of this sector. Now, it could just stay right here with XLU and say, am I getting a sign of a bounce? And I would argue that today, even though it looks like an inside day, it does look promising. And so I will oftentimes take a strong sector, watch for the pullback, the correction in that strong sector, and then take a shorter time period, an intraday chart, and say, show me that we are defending those lows. And as you can see through here, we have a low in the overnight on Sunday's open. We have that same low on Wednesday during the day. We have that same low today. And so this barrier at 76 has been defended over and over and over and over and over again in utilities. And where did we finish today? We sat here trying to decide if it was strong enough, and right into the close, just now, minutes ago, seconds ago, utilities jumped up, closed up, and I would say there is your confirming bounce. Now, the opportunity here is not just to buy in close to the low. It's that we're trying to trade this from the longer time period where we can get into a position in utilities, maybe going back to retest 78 in the short term. That's just the last week. If we look at the 6 month, we're talking about moves from 77, buying near the low with a very small or tight stop loss, looking for a move up to 80. So there's a $3 move there. We could easily get up to 83 before the next 6 months goes by. We are already showing that utilities and healthcare are the strongest two sectors from this rolling quarter. We could trade this for an entire quarter, pushing prices higher. If we look at XLU and were to ask the question, how much do you pay as a dividend, because these are dividend stocks, the sector ETF pays 3.25%. So number one, I could trade this from 77 to 83 and try to capture a $6 move with maybe a $1 stop loss. That's one choice. I have a $6 reward with a $1 risk. That's a pretty decent trade. In addition to that, I can get paid 3.25% annual by just holding on to this and collecting a dividend, let alone the fact that I can sell calls against it as it goes. If I were to look at this and say, well, I'm not sure I want to buy in yet, that bounce was nice, but can I get a better trade? Can I get a better setup? We could sell puts at 77, and if we sold puts at 77, they're going to pay us about 2.5% for just being willing to own it at 77 for the next month. And so selling a put at this level is a good way to set up the trade, to get into the position and wait for it to fill the trade at a better price. Now, if you don't want to trade the ETF, you want the higher returns, you can look at the individual stocks inside and say, look, there's a bounce here, a gap up, close higher in Southern. Southern's closed higher. It should be able to fill this gap, and I can take a trade from 89 up to 93. This candlestick pattern is a reversal pattern. It is a bullish reversal pattern. I don't even need to go into the intraday to look at this one, but that's a bullish candlestick pattern that could put us to fill the gap at 90 and then back to 93 and possibly all the way up to 94. And looking at Southern, Southern pays a similar 3.2% dividend on this stock. And as we're looking at others, Duke also gave us a candlestick reversal, maybe not a breakout of the consolidation, so it doesn't look as promising to get to the highs, but it does give a very strong bullish move today, up 1.35% while the rest of the market was down. And they pay a 3.54% dividend yield. And on EXC, Exelon, also a utility, you can see amazing run from 36 to 45, pulled back, and today's also a confirming candlestick pattern. Already filled the gap and closed past the gap. So I'd be looking for a move of at least $2, but it could be setting us up for a trend like this. And they paid the best of the three so far at 3.68% dividend yield. As far as healthcare is concerned, healthcare is sitting at what I would consider support. We have the pullback, the bounce, the climb up, higher highs, and then we pulled back to the same support level. So the same question stands. Is this a good place to buy? Well, we could certainly buy here at previous support. Let's take a look at the intraday and see if it defended that area. As you can see, we dropped down, we pushed through it. We did create an engulfing candle right here. That is some defense, but not very strong. So I don't want to go into healthcare ETF like I do XLU, the utility ETF, but I would probably take some time to look at the individual stocks and whether they are bouncing inside of healthcare, such as Merck. Let's take a look at Merck. Now, Merck has a gap down, close up, continued lower, has reversed through that gap, and still has some room to get up to fill the gap all the way up at 99.87. Today's candle, for me, would be a confirming candle. We had lower highs, lower lows today, engulfed that body and the high shadow, and closed above that high shadow and filled this gap. It's right there at the edge. That may be a little bit of a question mark. But if we're looking for Merck to go up to 99, we still have about a $5, 5% move higher in Merck. Now, Merck also pays a 3.4% dividend, so it doesn't have to move for me to profit by being in a stock like Merck. It could stay here, we get 3.42% dividend, and we still have the choice of saying, well, I'd be willing to buy it at 34, and if I'm willing to buy it at 34, they will pay us by selling a put at, 94. If we're willing to sell a 94 put, being willing to buy it at 94, not 94.71, they're willing to pay us $3, which is 3.35%. So we can get 3.35% for a month just being willing to own it at 94. So if we're unsure of this bounce, we could sit there and collect that 3.35% for a month. If it stays where it's at, if it drops down and tests 94, as long as it doesn't close below 94, we're going to get paid 3.35% for a single month. If it does drop down to 94, it's as though we bought it at 91. So that's quite a bargain for a stock like Merck. And the last one in healthcare that I'm going to look at with you today is CVS. CVS doesn't look like it's moving. It's had a very bullish day today, gapped down, closed up, traded higher, engulfed pretty much all the trading of the last week, 1, 2, 3, 4, 5, and is just holding here. Maybe that's not a great time to buy, maybe it is. But what I like about this is if we do buy the stock, it doesn't have to move again. It can just sit here. It can sit here for the entire month. It can sit here for longer because this stock pays 4% dividend yield. And so if we're getting paid a 4% dividend yield and collecting what would be about $2.60 over a year, it could sit here and we can collect the dividend and be like getting the stock at $62. But I can do the same thing that we just looked at the others. I could be willing to sell the put, or better said, own the stock at 65 and sell the put, and again, they'll give us about $2 or 3.3%. If I get assigned, then I immediately will start collecting dividends at the tune of 4% or higher, because if we're getting filled at a lower price, 4% or higher. So I can get paid 3.3% for a month. I can then collect a 4% dividend, and even if we just stay stuck in this range for the next month or longer, that's okay. We're getting paid premium on the puts, or we're getting paid dividends on the stock, and if we own the stock and it goes higher, then we can also sell calls against it and continue to collect money, especially if we can break through the 52-week high. But the resilience in CVS, after selling off so dramatically, we've held up here at 65 for the last 6 weeks, and the reality is the rest of the market has not been able to be so resilient compared to CVS in these volatile times where the equities have been sold off. So I like CVS for a safe trade, even if it's not going to move. It can still pay us 3% a month for short puts and 4% dividend. There's lots of opportunities in high dividend paying stocks, and you'll see that as we get more nervous, as the volatility remains high, you'll see a shift over to these what they call risk-free premiums, or at least low risk premiums. And that's why I'm looking at things like utilities and healthcare, and those that are paying 3% or more in dividends. Well, that's going to do it for me today. Thank you for watching, and we'll look forward to talking to you again next week.